Well, the market is still doing very well when compared with all other calendar years since World War II, and it's also followed a fairly similar pattern. We had a very strong first half of the year, strong enough that it's now in the top 20 since World War II. But that typically points to a lackluster third quarter, which is exactly what we got. A slight advance that was topped off by a negative September. And now we're into October, which traditionally is quite a volatile month, but ends up being among the top 50%. And then that starts us off for the seasonally optimistic remainder of the year. So I would tend to say that strong start, favorable finish is how we will likely see 2021. The real question, however, is will the Fed need to accelerate the tapering as well as the initial rate hike? So that, I believe, is the primary concern that investors should be focusing on. I think the higher oil prices is more a reflection that the global economy is reopening and things are getting better. Wall Street was expecting these two infrastructure packages to boost value-oriented stocks, those that would benefit from the improvement of our infrastructure. The initial package that is true infrastructure spending has approval from both sides of the aisle and could easily pass. But trying to then link it to the $3.5 trillion package is now causing both packages to come into question. So I think that is one of the reasons why Wall Street has been tracing out the design on Charlie Brown's shirt and not really going anywhere over the last several months, because it's still trying to decide whether one or both packages will be approved.